Stocks pulling back again today to close out a losing week on Wall Street. My next guest says growing recession fears could drive the market even lower. Joining me now, Post 9, Kevin Gordon. He's Charles Schwab's Senior Investment Research Manager. I mean, it's nice to see you again. I've had like really bullish on today, really bearish on today. Yeah. Where do you lean?
I lean bearish in the near term, bullish if you're extending your time horizon, I think at least a year out from now. And, you know, one of our themes in our outlook, which we just put out a couple of weeks ago, was that, you know, a lot of the sentiment conditions that you saw in September, October got at or near extremes that if you were looking out longer, at least a year out, it's suggestive, at least going back in history, that you could see better days for stocks. But that obviously hinges on the Fed being able to sort of check the box on the labor market side. Now that inflation is in the rear view, I'll say the peak is in the rear view. Can't declare victory too soon, is what we've learned this week from Powell and other speakers. But if they start to see, you know, increased success there, but you also start to get more of the labor market pressure in a form of a higher unemployment rate, wage growth coming down, which isn't happening yet, then we see, you know, better days a little bit longer term. But I still think in the near term you have a lot more volatility driven by probably what will be more of a tightening in financial conditions.
You see several more Fed hikes ahead?
I mean, it's tough to say how many more.
Well, you have to sort of have an idea in your head if you're going to formulate an idea on where the market could go. That's why I ask. You know?
I don't think it goes it's as much about how many more hikes. I think it's just how much they adjust the terminal rate, if at all, from their most recent expectations. So February, probably, obviously, a lock for a hike. I don't know if 50 versus 25 matters as much, because I think we have a lot more data to get through before we get to that meeting.
What if we have, let's put it this way. What if we have, let's say, several more 50 hikes? What if we have several more 25s? What happens if we go higher than the terminal rate that they even suggest they're at now?
Yeah, I mean, I think there's definitely more of a risk of over-tightening. And there's also a question still right now that we don't have the answer to is, have they already over-tightened from the series of 75 basis point hikes? So I think, yeah, if they go further, it would be for good reason in their point of view, where you would have wage growth that's still too strong, inflation that for some reason isn't coming down at a rate that they want. I think that would definitely be worse for risk assets, and you'd probably push out the time horizon for when we're able to recover.
I mean, is it time now to I guess invest more significantly as though we're going to have a recession? Is that how you're thinking as we enter 2023? If you think there's near-term pain before longer-term gain?
So we're already in a form of recession. It's rolling through different parts of the economy. And this was really our theme for 2022 and was telegraphed by the market in 21. You had a series of rolling bear markets at the member level, at the industry level, that was happening in, by way of rotation, keeping the index afloat. That is what we saw in the economy in terms of rolling bear markets within the economy itself. So we think that now that you've seen more weakness at the headline index level this year, probably going to see it spill over more into the labor market and corporate earnings. That's where you haven't seen the recessions yet. But the idea is that with the weakness in housing this year, with the weakness in CEO confidence, consumer confidence, if you get a stabilization in the first half of the year, I don't want to date it just to June, but if that starts to happen in the context of a labor market that does soften, that's probably going to set you up for a better mix for risk assets. But obviously it hinges on the labor market.
What do you like in the market now? And in the same breath, what feels too expensive for you here?
Well, I know quality has become a cliche these days, but specifically earnings quality, profit margin, protection, but also strength moving forward. You have just a significantly fewer amount of companies that are able to exhibit that quality. Only 30% of the S&P with positive earnings revisions over the past few months. So I think you have to look there, but also now a theme is being able to withstand pricing power as top line growth comes down. By virtue of what we saw at the retail sales report this week, nominal growth is starting to slow now, and so any company that can maintain more pricing power, not by expanding margins to a significant degree, but at least holding them and not being able to withstand higher input costs still, that's where we think you're going to probably find the most success.